Hi, this is Peter with Quantum Edge AI, and this is the back ratio. Now, the reason you do this is because you believe there's going to be a substantial move upward. The only risk you have is that price doesn't do anything and you lose that net debit. Now, what you want for this is to blast through this location. This, in order to structure it uh, properly, um, You want you want this to be, this is the high forecast. So what you're going to do in this position is trade this. You really have to exit this position if you use it. That your total potential loss is $192, but you see your theta decay, you're going to be losing quite a bit of money, but you have to be um, very not certain, but the likelihood of this thing blasting off is highly probable. So that's what you want. You want a strong movement upward. You believe this thing is going to rocket upward and do so within the timeline, within this uh, within this timeline specifically. So what is this? This is one short contract, two long contracts, and the short contract is closer to price, and the long contracts are out of the money, further from price. Um, you can construct this in a different way. You can say, okay, well, you know what? I want my short contract to be here, closer to the money, and my long contracts to be a little bit closer too. Maybe you think, okay, well, this is the close where I think price is going to be, but I also am hedging these long contracts with this. So your total move downward, your total P&L loss downwards, in this case is $1.68, and for each spread is $108.68. Um, see this theta decay, you're going to be taking a hit on that theta decay. So you need this thing to move very quickly. But in the event that it does hit the high forecast of 198.66, you are going to be very happy because you're going to have 163 total risk, and here you're going to be positive 258. So that's a very high reward, low risk strategy. It's just that you need to be very cognizant of this theta decay over time. You will be losing money in this position. Um, so why would you want to do this? You think, okay, well, your Vega is relatively neutral. You have this downward movement, and you think this thing is going to blast through the roof very quickly. uh, you can do that with this trade. Now, remember, your risk is $168 as long as you're not in the money here at expiration. Um, and you see this thing, potentially going to 199 for the high forecast and continuing and rocketing through. Um, that's the potential for this trade. You have exponential movement upward. Um, it's like, you can simply say, you can just be long the contract, and that's one way to do it too. Um, but as you can see, uh, this risk is more in a way because you have that $585 per contract. The reason why you set up the back ratio is because the short contract is somewhat de-risking your long contract. So what we can do, set up the back ratio, and we can adjust it according to how Quantum Edge AI's forecast foresee this. What is the likelihood of the forecast of the price and its range and channel and all that. So we can say, okay, well, we want to sell the at the money and we want to sell maybe the close forecast, and then we can sell at this location. This is our target. We want that high forecast to occur. In the event that high forecast occurs, we're going to be very happy campers with a $300 to $400 gain, subtracting the time it took to get there. So that is the back ratio. You want to be careful that you're not in the money at expiration here. You want to close this position prior to expiration. And you can remember, you can also structure this trade slightly differently too. You can customize this and put this position out further. Now, this is going to be uh, interesting for a few reasons. Um, your net debit is a lot greater, right? Your potential loss is a lot greater. This still is finite risk. Um, but another thing is what's great about this too, though, is that you're selling this contract at the money and generating theta. So you're generating theta in the short term. Once this contract is expires worthless, if it does, you've net this premium. You have this long contract out of the money and further out in duration. This is a better structured trade because look, you have that theta positivity. You still have that upward movement. But the one thing you don't have is that convexity to the upside. You can actually maybe do 200. Um, but the one thing is you still don't have that convexity until way later. Um, it becomes convex here, exponential, but not truly convex. Um, So that's the back ratio. You can construct it with multiple durations, different expirations, and you can construct it in ways that generate theta or that do not generate theta, which would be the same actual expiration. The back ratio is great when you think about it a little bit further. When you don't just say, okay, this is the back ratio, this is what I want. This is an exponential movement, but the odds are that you're going to land within this location, and you're going to be basically net debit losing this position. You're going to be losing this position. But if you were to, like I said, structure this expiration further out, you're going to be in a position where this front week is actually losing a lot of capital over time versus um, that long out of the money in a further expiration. Um, so that is the back ratio. And if you think about it, this is a good strategy except for this theta decay. If you move out these expirations, you're going to be in a much better position, I think. But it ends up being more like long stock. But you still have that theta positivity that generates income, which is very, very nice. If you have any questions, email me at peter@quantumedge-ai.com. You can also comment and I will respond as quickly as I can. Thank you. Bye.